Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth, yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
Welcome back to another episode of Rebel Wisdom. B, I was gonna say let's get into some modern portfolio theory today, which is perfect for our podcast because I feel like within the title that modern piece already implies like some rebelling or some different than the past. We did modern monetary theory on a previous episode, which, you know, similar concept there with the rebelling and how times are changing fiscally or like economically. So I think this is good and super relevant and on brand, and I'm excited to get into it. With that, I guess we can go into a little bit of history. What I know of it is this super quick background. It was, I guess, theorized by Harry Markowitz, right around or about like the 50s. And this was kind of revolutionary, I guess, for that time, bringing on this theory. And I guess why it was revolutionary is because he started putting numbers to theory and was able to kind of quantify and measure for, how to grow or people's portfolios. So much so that it won like the Nobel Peace Prize, which is, I guess, the highest accolade typically that a economist can receive. So pretty dope and kind of why it's powerful. And even like to today, I think it's the leading theory, I guess, that investors use, which is saying a lot. I mean, 50s, that's all going on, towards a century, like 70 something years now. So pretty impressive there. A newer concept to me, but in learning about it, I can see some parallels on kind of what I already do. Again, for me personally, it's like far less quantitative, but conceptually, like the ideas are kind of what I try to follow. So I thought that was cool and like forced me to lean into it a little bit, which is a large part of the reason, I'm interested to talk about it. I want you to like add on the what do you know about it or history wise about why it was so impactful or whatever.
Yeah, so basically, right, like modern portfolio theory, I got to be careful with modern monetary theory as well.
Dude, yeah, I'm going to jack it up. I know I am.
Okay, modern portfolio theory is basically this idea of maximally optimizing risk versus reward. And this has like so many implications to today. And I don't want to say like his theory is the father of everything that we do today. It's not necessarily like that, but everything that you hear today on how you should be investing ultimately ties back into modern portfolio theory. Like I'm sure if you're in the investing space, you have heard of, hey, just buy the S&P 500 index, buy the whole stock market index, buy, world stocks for emerging markets. And this is all part of modern portfolio theory. And this is like especially impactful because prior to him winning this Nobel Peace Prize for economics on this topic, people back before the 50s, like they weren't complete morons, right? Like they understood the system, like the risk of a single stock. Like if you invest in it, it has high returns. Like that's why you invest in it. You're hoping for the high return. But then also, like if something happens to that one individual stock, like you could lose everything, right? So they understood that. So they like the idea of diversification that was emphasized. But what modern portfolio theory basically established, like Julian said, is putting numbers to the theory of diversification, and then actual numbers is like with equations and saying like, hey, based on these data, this is the expected return based on the risk level for the investment portfolio that you have. And in today's like hedge fund manager, portfolio managers, like these people are using modern portfolio theory to invest. So with that being said, I think it's definitely relevant. It's things that much smarter people than me are utilizing. So I think it's definitely a good thing. And yeah, I guess I'll just leave it there and then we can start talking about it.
Okay. Dude, with that, it using these equations and kind of being heavy on the math, listening to some of the videos, they're talking about the sigmas, the lambda, the standard deviation from the average, whatever. But I was watching this one video where it's breaking it down, nothing like a lot of numbers, but it could have been way worse. It could have been more math heavy. But they're like, yeah, in the YouTube description, like there's an Excel sheet. Feel free to download it and like use it yourself. And I'm like, you know what? Let me try this. And I opened it, and it was pretty well formatted and stuff. But even still, I'm trying to like follow the equations and see like, okay, it's like weight, like the different weights on the portfolio and stuff. Which I think I want to play with it more, just more so for like a education learning piece, because I do think this theory is super interesting and again clearly relevant. But I was just like, dude, I opened that spreadsheet and I was like, dang, it started to make my head hurt. But I mean, yeah, nonetheless, right? I think it's a good concept. And again, going kind of back, and I'm thinking clearly it's modern in a societal sense, but also just from like a household, when we talked about multiple episodes about things that we think, could be taught in schools or even just broader concepts. And I feel like even if you don't go into the equations, maybe depending on somebody's major on a collegiate level, right? Like economics, you would get into this, but even on a basic level, these are good diversifying, concepts to teach, because I feel like as a kid, or, you'd see little Timmy and you're like, Timmy, if you save $1 every day this year, at the end of the year, you'll have $365. Like, oh my God. Right. But if you're like, hey, Timmy, if you invest this $1 every year and it's in an account, I don't know, that has 3.5% interest or yields, whatever, like you'll have more than that. And it's like, or if you put this dollar in these couple different, you know what I mean? Just, you can teach it on a more basic level that I think, again, I think it could be more widely talked about, and we can get away from some of the traditional narrative. Like, right, saving money is not bad. It's good. It's inherently good. But this, I think, modern, I'm just going to say MPT. Jesus. MPT focuses on that risk reward relationship that you talked about to like maximize how you, I guess, invest in like your different assets. So yeah, it should be fun.
Yeah. So without getting too much into the math, because I think it's not going to do justice on a podcast to go through math, right?
I can't get into the math, so yeah.
So I think concept is the more important topic here. And basically, like the first thing I do want to talk about is just like the definition example of expected return, right? Because a lot of people with, expected return, they don't calculate the risk portion of it, which is literally the other half of the equation. Let's think of this. You have a coin, right? You have a heads and a tails. So you only have two expected outcomes. And let's say that if you flip heads, you have a 10% return on your money for that year. So annualized. And let's say if you flip tails, you have 0% return. So you're not losing money, but then you are just staying stagnant, right? So that's pretty much the two information that you need, like the expected outcome and then the expected gains from that outcome, which the expected outcome is heads or tails, so 50-50. And then the expected outcome is plus 10%, or expected return is plus 10% or plus 0%. So with that, you can have a simple equation in your head pretty much saying, so if my return of 10% happens 50% of the time, that's 5%, right? And if you take the other half of 50% and then 0%, that's still 0%. So at the end, you have an average of 5% out of this scenario that we have. So that's the expected return given the risk level. So that's 5%. So this is very important because like that was like a one system, that was like a one investment thing. Whereas, you could be very unlucky in a way that you keep flipping tails, right? Like, it could happen. You could flip
Yeah.
tails for until you die. And then soon as you stop investing, it has
Yep.
the historic heads run that we have ever seen in history, right? So in order to prevent that, there's an idea that um, Ray Dalio, I think, coined this term, the Holy Grail of investing. You can look it up. Type in Holy Grail investing, Ray Dalio, and he has like a YouTube video about it. He's talked about it countless amount of times. But basically, his claim, and his claim is something that we all should be listening to as the biggest hedge fund in the world. If the CEO of that hedge fund is talking about this, it's something that we should be listening to, I think.
Mhm.
But basically, he says that the holy grail of investing is to find at least 10 to 15 investments that are uncorrelated. And
Mhm.
that sounds so it's actually much harder than it actually sounds. Because the uncorrelated piece is what's very difficult for a lot of people, and me included. Because in a diversification, I guess like a classic example, right? Think of like Home Depot versus Lowe's. They are two
Yeah.
separate companies, two separately traded securities in the stock market.
Mhm.
And you would say, instead of putting 100% in Home Depot, just split 50-50 on Home Depot and Lowe's. But then when you kind of
Mhm.
look at the expected return and the correlation between those two stocks, it's very,
They're
very
heavily
heavily
correlated.
correlated, right? Like, they're
Yes.
in the same sector. I guarantee if Home Depot goes down, Lowe's is
Yeah.
probably going to follow, right? And this, you can think of a lot of different things like that. And on a much bigger scale, right? On the ETF talk that we often talk about on the show, like I like SPY. SPY is or we can go VOO. I think VOO is the more common advice that people hear. So
That's the one I
VOO,
invest in.
yeah, VOO is the S&P 500 index fund by Vanguard, and so it tracks the S&P 500. Pretty simple, right? And
Mhm.
then people also confuse diversification with, well, what if I buy VTI? VTI is a Vanguard ETF for the total market fund. So not just the top 500 companies, but the entirety of the stock market. So, like, yes, you are more diversified, but then look at the stock chart. Look at the stock charts of VOO versus VTI. It pretty identical, right? So
Mhm.
in this case, like, even though how many stocks does the stock market have? Like 8,000 or 10,000 different
Yeah.
stocks? Even though you have added 8,000, 9,000 more stocks into this ETF, you're still getting the same returns, right? So it's
Yeah.
not more diversification that's like the important part. It's the uncorrelated piece that he's like talking about, right? And
Yeah.
here's some examples, right? Like bonds and stocks. Usually they are uncorrelated. And recently in the past 5 years, we have seen where stocks and bonds go down, which is a very vast scenario. But typically speaking, like bonds and stocks are not perfectly uncorrelated, but it is uncorrelated enough. Right. Same thing with like, I don't know, like Bitcoin or crypto. They're not I, they are kind of tied to the stock market in terms of returns, but then there's so many other factors that tie into it. So we could kind of say here that's more uncorrelated. We can think about cash. Cash is a very good example because S&P 500 or the stock market in general, we're expected like an annual return of 10%. That's been the average for a long time, and that's the
Mhm.
benchmark that pretty much everyone uses. But with cash, regardless of what the stock market does, you can grow cash at a fixed percentage, usually with bonds or through high yield savings account. So that has nothing to do with how the stock market performs, right? So that's a very good example of uncorrelated assets that you have. Do I recommend, you know, a lot of that money into high yield savings account? No, I don't, because
Mhm.
it's pretty much a for sure investment, and therefore has a low return because it's pretty. I think it's 100.
Right. Because it's
I
low
don't say
risk.
100%,
No
but
risk.
yeah, no risk. Pretty much negligent risk, therefore low returns. So
Yep.
that's the example of why the finding 10 different uncorrelated investments or assets is much harder than you think. And another thing
Yeah.
you can throw into this mix is real estate, right? So that's a pretty popular one.
I want to
It's
add something to that real quick, B.
Yeah, go ahead.
If I don't know if you're gonna get to this, so like take over if you are. But you're saying like the uncorrelated assets. I think, well, for sure, like uncorrelated and negatively or inversely correlated, I think are beneficial too. Which I don't know if you were grouping that in uncorrelated, but I just wanted to make that distinction. Like two things could have zero correlation, or two things could have a correlation. It's just not a positive correlation. Like when one goes up, the other goes down. And I know in this theory, they also talk about like having those as well because it'll balance your portfolio. So I was just throwing that in there.
Yeah, that is a good distinction. That yes, you're right. You're absolutely right. There's some
Yeah.
So with like I'll go more into the the details of MPT, right? So basically, so I don't personally agree with this particular definition, but this is the definition that they use. And in defining risk, because risk means it could mean a lot of different things to a lot of different people. I have a view of what risk is, and that's particularly like if I invest in something, what is the probability of going down and also going to zero, which is two different things, but that's like how I define risk. Whereas more common, typical view, I guess, on the average,
The
which
volatility.
is exactly, which is what MPT uses as risk, is volatility. I personally believe risk and volatility are two different things, two different words, two different measurements, but in MPT, it is basically one thing. Just think about it like that just for the next hour or hour and a half
Good
or
point.
whatever, how
Yeah.
long this thing is. So we all know in diversification, that's pretty simple. Like don't put all your eggs in one basket because even though that could go up, like that could also go down. And at the end of the day, if you lose, it's just harder to gain back, right? Like think about the Warren Buffett's quote. He has two rules of investing. It's kind of comical, but rule number one says
Oh, I know
never
which one.
lose money. That's number one thing. It's not about diversification. It's not about the capital. Number one rule is never to lose money. Number
I think I
two,
know the other one.
number two rule is never to forget rule number one. So it's basically saying that's the most important thing, right? And then kind of think about it mathematically too, right? People always confuse this too, the average return or real average return. So for example, people confuse this because if stock market goes up by 10% one year and then 10% down the next year, what is the average return you just received? You go up 10, you go down 10. So the average will be zero,
Nothing.
right? In terms of like regular
Yeah.
calculation. But in terms of real return, you do the math here. I'll do the math right now. So let's say you have $10,000, right? You have 10,000 here. Let's say it goes up by 10%. So you'll do times 1.1. Then you have $11,000, right? That makes sense. Next year, you lose 10%. So you multiply that
But it's
by
10% of a
0.9.
higher number.
Exactly.
Yeah.
So 10% of a higher number is greater than the 10% that you gained from the lower number. Therefore, what you end up is 9,900, even though we said 0% was the average return.
Yeah.
So in that logic, this is where the rule number one comes in for Warren Buffett. Like you have to have like a crazy amount of return just to get back to zero if you lose money. So the whole point of MPT is so that you don't lose money. So you keep compounding at a rate, and then compounding is the eighth wonder of the world, right? And it will do magical things for your portfolio.
Who said that? Was that like Einstein or something? I think said that?
Einstein said the eighth wonder of the world. And I'm sure figuring out gravity, and
Yeah.
I think he knows much more than what I would.
Yeah. He's not the dumbest guy for sure.
So going back into MPT. So basically, with the 10 uncorrelated stocks or assets, sorry, not stocks, assets. Basically, the idea is, even if you have something go down, you have other 9 things that go up, or maybe, whatever, maybe 3 goes
Maybe
down,
8.
but at least
Yeah.
7 goes up.
The
So
majority. Yeah.
overall, your net worth and your investments are growing, and you are minimizing that risk to, like, close to 0 as possible. Is that ever possible? No. And this is where we get into 2 types of risks. You have systematic risk and you have unsystematic risk. And this is pretty easy. Like, I
I
may,
don't think I've heard of
like,
these
previous to this, like,
distinctions.
you may not have heard of it, but it just makes sense. So
But yeah.
systematic risk is even if you are diversified into everything. Like, look at the ETF VT. It is the World Stock Index by Vanguard. It has everything. Can you get more diversified into stocks than that? You
Yeah.
cannot. But the systematic risk is, what if the entire world economy goes down?
Right.
We go into this, like, crazy 3-year bear market for the entire world. And can you control that? No, not really. Like, you can't really win in that situation unless you're
Not at
shorting
all.
the entire world economy, which that's probably not a smart plan either. But anyway, so that's systematic risk, where even though you're diversified to a crazy extent, even though you're following this MPT theory, like, you're still gonna have risks that you just cannot control. That's systematic risk. Unsystematic risk is basically more on the individual asset level. And then this is like, for example, you have a lot of unsystematic risk if you just invested in Apple. Even though Apple has a good track record of growth, like,
Right.
you don't know if they're gonna collapse tomorrow. I mean, think about it, right? Like, we saw it. It's not the craziest idea for that to happen. Like, for example, we had, like, the Lehman Brothers, like, before the 2008 crash, they were considered a very safe stock to invest. And one day they just go bankrupt. Am I saying that it's
Bro, that's
gonna
me. That's me
is
with
that gonna
Nike
happen
right
to
now.
Apple? I don't think so, but it's possible, right? So that's
Yeah.
the unsystematic risk, and
Yep.
unsystematic risk is, you can combat that with diversification. So, going forward, you want to have, so you can approach MPT in 2 different angles. You can look at expected target return, or expected or you can optimize for risk level that would give you a target at the best return per giving that risk level. Does that make sense?
Yeah.
Yeah. So okay.
Yeah. Yes. Yeah. You can target your bit. Yeah. Yeah.
Yeah. So basically, if you want 10% return on average, so that's your given, like, you are defining that expected return. You want 10%. So when you define that 10%, you want to have the lowest risk possible to get that 10%. So that's one
Right.
angle. The other angle is, you say, hey, I only want this amount of risk. If I define this risk level at this value, what is the highest level of return I can expect to optimize for
Within that.
given this risk level? So it's just
Yep.
like 2 different sides you're attacking it from. So either
After.
way, the whole idea is, you are optimally managing either the risk or the return, or the combination of both in your portfolio. And that's the essential, like, bare bones of what MPT suggests. And then that concept alone is not revolutionary. I mean, I guess it was, but what made it extra revolutionary was that he was able to put formulas and numbers into calculating all of
Right.
this stuff that obviously the equations are not going to change from me and you, but how we calculate, how we put in the numbers, like you could say, no, S&P is going to return 53%. I'm like, no, that's so unrealistic. I think we should stick with 10. So there is subjectivity into the numbers that you define. So, I mean, you have to do this for yourself personally, but the equations are there if you look. It's not too hard to find.
Okay. And I think, I'm only bringing this up because I think actually, I think it was Ray Dalio who he brought up, said in an interview, don't quote me on that though, but that MPT is more, I'm trying to use my words carefully, but is better for managing wealth than growing wealth. And this is one of the, I'm going to say cons to MPT, but one of the more negative views or misaligned views of MPT, because, what we're saying, and it seems like it's to grow wealth. And I think in the stuff I've looked up, it talks about the standard deviation away from the average, and maybe you're trying to achieve based on your, with your risk or, I guess how much you're trying to grow. It's like the standard deviation away from the average, which I feel like implies that it could grow, like it could be a tool to grow wealth. But again, I think it was Ray Dalio said that it's more so for management of wealth than the growth of wealth. Like a lot of billionaires or, the high, I'm talking about extreme high earners, use these theories to kind of like manage their wealth once they have a lot. But maybe in the pursuit of growth, there may be better tools or tactics to further grow. And again, probably going to be more risky because I think risk is associated with return, as MPT suggests. But that MPT is better for management vice growth. Do you have any thoughts on that?
Yeah, I see. I definitely 100% see where you're coming from, and I agree to an extent, obviously. But I think,
Yeah.
I think MPT as an umbrella, it covers everything in terms of growth or the management of your wealth. But I understand where you're coming from, where MPT, like Ray Dalio is talking about it, then he's a hedge fund, right? He's not
Yeah.
necessarily there. His clients are not net worth of 100K trying to go to 1 million. That's not his audience. His audience is someone with a few $100 million. They don't need to earn any more money. Like, why do you need any, right? But you earn that money. You got there. You don't want to lose it. That's why it's
Right.
called a hedge
Right.
fund.
Right.
You're
Right. Right.
hedging the risk. So I see where you're coming from, and I do agree with it, because if you optimize efficiently with MPT, you are doing exactly that. You are maintaining your wealth, growing slowly, very low risk, and yeah, that's your purpose. But also on the
Yeah.
flip side of MPT, you could also. So sorry, let me back up real quick. So the managing wealth, you're kind of thinking about you're defining the risk level first and optimizing for the return, right? That's the second angle that we were talking about like maybe 5 minutes ago. So that's more on the management of wealth, um, preservation of wealth standpoint. On the growth side, you can still apply modern portfolio theory with defining
I think
the
so.
expected return. So you can set that expected return higher to like 15%. And so inherently, if you go up, the benchmark for the S&P 500 is 10%. The higher you go from 10%, inherently, you would increase the risk level.
Your risk. Yes.
Yes. And depending on your ability to apply MPT, that risk level could be, 50% or 20%. And obviously, given that 15% return, you want to minimize your risk to the lowest point possible. So I think you can still apply it, but then there's also a thought of like Charlie Munger. I don't know if you heard him say it, but he advocates, if you are an average retail investor, me and you, he does not recommend picking stocks. The ETF, the investing
Right.
in VOO, is like literally he has said it's probably the best method for 99.9% of the people. But for the people that's like their profession is picking stocks, he says diversification is I think he said a much harsher word than stupid. But basically he said diversification is stupid. And I understand why. I understand the angle as well, right? Because like if you're really good at stocks,
You know.
picking stocks, and you know with
Right.
absolute confidence, 99.9% certainty that this stock is gonna double in the next year, why would you
Or not.
diversify? That
Yeah.
makes
Yeah.
no sense. Just buy that,
Yeah.
borrow debt against it, buy call options for it, and you're gonna make your money much faster. And I think that's where you were coming from. You have to take risk to, just beat the market, I guess, right? By a
Yeah.
substantial amount. And I'm sure, like, if you're lucky, it's not crazy. If S&P returned, I don't know, 13% for the year. If you had a couple individual stocks that you got lucky, like you could have got 14 or 15 or
Yeah.
20. Like, it's not
Yep.
a
Yep.
miracle. But to do that consistently
Repetitive.
over however many years, that's the hard part, right? So I guess that's
That
my
Warren
thought
Buffett
on
status. Yeah.
like preservation of wealth, growing at a steady pace versus trying to take asymmetric risks to, achieve greater amount of wealth in a quicker time frame.
Oh, the asymmetric risk that came up too. Yes, that's good. And you said some good stuff. I also think I feel like this is kind of a cop out answer, but I also think you can do both. I want to develop more of an opinion on it, but clearly, and you kind of broke it down, but I think it certainly can preserve wealth, but also can maybe due to how it's structured grow wealth. But you mentioned audience, and I want to kind of go back to that. And you said like Ray Dalio, bringing it back to him too. The people he's interacting with or the hedge funds working with are probably high earners, big companies, whatever. Like we're talking a whole different like weight class there. But he was, and this I do know was to Ray Dalio, and I think what we try to speak to the general audience on this podcast. So we'll mention all socioeconomic classes or tax brackets, but generally we're talking about the everyday people. And Ray Dalio was asked like if you could pass on one thing to like the average, I don't know if it was investor or just like your kid growing up in the investment space, right? And he has this concept, like I don't know, if it's his concept, but it's like the all-weather portfolio. Have you heard that?
That's
Yeah, where I guess it's referencing yeah, and it seems like a type of MPT, and it's just like to have something that's diversified, that's like repeatable, and it can grow in quote unquote all seasons of I guess growth. It's like what I looked
all
up before.
stages of economic
Growth,
downturn.
growth, recession, inflation, and deflation.
Mhm.
Yeah. You can see growth across all of that. And so I feel like that's a version of MPT, and it kind of showing that it can grow. Like MPT is valuable because it can grow. I mean, not only can you adjust it, but it can grow in all the cycles. Yeah. So I thought that was relevant to like the audience, and again, using him as an example because he's kind of like the epitome of this cover. He's at the peak of we're talking using this concept, and he's recommending things like this all-weather portfolio, which illustrates the MPT.
Yeah, and then just to give more, I guess, there was a lot of theory, right, so far. So I do want to give more tangible, like definition, things that I could find, and this is in regards to finding uncorrelated assets, right? I'm not saying this is the best investment. I'm just saying these are typically what's considered uncorrelated. So I'll just kind of list off a lot of them, right? I guess like one of
You
them
giving
is
examples?
examples.
Okay.
Like number one, like U.S. stock market and stocks, right? That's stocks and the stock market. You can kind of think about in two different things for this. for this case, individual stocks in the broad index market for the U.S. market. You also have international market. You have international stocks. You have U.S. bonds. You have international bonds. You have corporate bonds. You have government bonds. You also have real estate. And within real estate, you have single family, residential. You have multifamily. You have office spaces. You have you can do like a triple net lease with corporations. Um, you can invest in commodities. You can invest in hard assets like gold or oil, right? Um, and cash, I already talked about. Like you can just hold cash. That is a form of an asset, even though I don't recommend just holding cash. Cryptocurrency, we talked about that for a little bit, and that's like more on the new things that came up. Yeah, I think that's like the tip, like the big ones that retail investors would get into. And if if and when, I'll say when, just to keep it super optimistic, there is a book by Tony Robbins, and I know not everyone's a fan of Tony Robbins, right? But then because a lot of things is basic conceptual things. But he has one of the new books that he mentioned, he released. It's called The Holy Grail of Investing. And obviously, this ties into what Ray Dalio was talking about, the all weather portfolio that Jillian was talking about. But basically, like the premise of the book is listing out these uncorrelated asset classes in this book with whole bunch of details, and it's very eye opening. I read it. I read it early 2024, and I do want to say it's a more of an interesting book, more than something that's applicable to me, at least for now, because a lot of these investment classes that's truly uncorrelated, the best ones, the retail investors necessarily don't have access to because you have to be an accredited investor.
Right.
And to be an accredited investor, you have to have, I think you have to have, there's a couple of criteria that you can meet in order to become one. But then I'm just going top of my head, so I could be wrong. But basically, you have to have a net worth of $1 million that they will have to verify without counting your equity in your primary home. Or you can make on a salary, not a total comp level, but on your salary level, you have to make 200K or more as as a one person, or you can, if you're married, you have to make over $300,000. So that's pretty much the way to become an accredited investor. And once you become an accredited investor, like you can go into all of these crazy new world of new asset classes that you can invest in. And one of the things, like couple of the things I'm trying to remember, I think he lists out like 13 of them, but one of them's like investing in sports teams. Like there's funds that you can put money to buy. I don't know. You can buy the Arizona Cardinals or Chicago Bears or the New York Mets, right? Like there's funds out there that you can buy into these big sports teams, and they are uncorrelated asset class that, again, obviously we don't, not everyone has access to, but that is a form of one example. Another one's like private equity, right? High risk, high reward. You have like, you can have like private loans, like corporate, like you can in the form of a ATO on a fund, like we all pool money together to lend a bunch of money to corporations. And that is typically, it's a fixed return asset. So it's uncorrelated from stocks and usually gives very high returns for the low risk level. So that's a few examples I kind of thought about in my head, but that's a book that was very interesting, not applicable to me yet, but hopefully I get to partake in those investments in the future. And I think a lot of people will as well. And then at that point, a lot of knowledge and who what come into play. Because like for the retail investor, right? Like you don't really need to know anyone to make good money. You just buy the S&P 500 and forget. Like, you don't even need to know that much stuff or know a lot of people to do that. But yeah, I just offering that as it was something that was interesting to me. So if you're interested, that's there.
That is. Bro, it's crazy you brought up the sports teams. I think last week or this past week, 3 sports teams, which is like unprecedented, all sold a fraction of the teams, which like
I think I
again
saw. I
doesn't
seen
really.
few of them.
Yeah, it's like the Bears, the Patriots, and somebody. One sold like 10% ownership of the team. One was like 8, one was like 9. Yeah.
Mm-hmm.
So I think that's funny. Yeah. Okay. What do you think are some drawbacks of MPT? Because as I stated, definitely like to analyze both sides, and as I stated, right, I want to get more into the numbers, and like I personally downloaded a spreadsheet to kind of play with the numbers in my own life. But conceptually, I think I try to lean towards the concepts in this theory, because it is a modern portfolio theory, like lean into the theory, right? And so I am a general believer in MPT, but in that it's genuinely like I have to really think on like what some of the drawbacks to this might be.
Yeah, I
So I've
think
been trying to wrestle with like what are some of the
I think the biggest drawback is not the theory itself, but
mm-hmm.
trying to implement the theories incorrectly. I think that would be the biggest risk. And I give the example like very early on of like the Home Depot versus Lowe's.
Mm-hmm.
If you
Oh, okay.
apply the illusion of diversification, but in reality, if you're not really diversified, you are
Yeah.
still very prone to the unsystematic risk that we were talking about.
Mm-hmm.
So, how am I trying to say? Like, I also did this early in my investment career, if that's like
Mm-hmm.
that cliche phrase, but like, I also thought, buying buying VOO and VTI was like, oh, more diversified, but you're really not.
Doing that,
So
yeah.
just if you don't apply that important piece, very important piece of uncorrelated assets, if you don't implement that properly, like you're still prone to the risk. And I guess that kind of goes away from MPT, but then people have the illusion of applying MPT. I think that would be the biggest risk or drawback for this, just not knowing enough to apply it to your portfolio.
Okay. Yeah, and I definitely see that, and I think it just comes with like I guess financial literacy or whatever.
Mhm.
I didn't come to this conclusion, but I think one thing I saw was people saying that MPT doesn't account for all the risk in the economy.
Yeah, that's a
Or
systematic. Yeah.
um, yeah. Oh yeah, you did kind of say it with the systematic, the stuff you can't control, I guess, more so.
Yeah.
And saying that MPT has no good way to account for that.
I th that
Yeah.
is I mean, that's absolutely true, but I'm trying to think how you could combat that, and I don't think you can, because there's gonna be some level
Right.
of systematic risk in
Th-
any form of asset that you
yes.
buy.
It's always gonna
Because
happen. Yes.
we always say, US government bonds, is the, risk-free asset that returns low, whatever, right? But it's not truly risk-free. We have seen countries and empires fall in the past. So it would be crazy to say that United States is immune from collapse. I just that's not. I mean, it's very low risk. I don't. The
Yeah.
probability of it happening is like close to zero, but I don't think it's zero.
And I guess this also kind of ties into what you stated actually earlier. Now I'm thinking about it, is that MPT defines risk as volatility, which is
Hmm.
just the frequency at which not a stock, an asset, I guess, can like fluctuate. But it's again, the risk can be outside of like there could be like politics, something happen in politics, or like credit card inflation, you know what I mean? Just things that happen outside of the volatility of like, an asset that can affect. So I guess, it was saying that MPT is one dimensional when it comes to risk. But you kind of touched on that with the systematic risk, and with saying like you don't believe in, or you don't necessarily, your personal definition of risk is beyond just volatility, but that is how MPT describes it. I think that's actually a valid one.
Yeah, I do want to talk about risk now. I do want to go and talk about risk, and I know we have talked about this many times over the years, but this is something that I feel like very strongly about. That's why I want to kind of plug it in.
Heck yeah.
And just understand, like, I'm not here to say that I'm smarter than anybody else, because I am going against the definition of risk that's defined in MPT. But I personally have an issue with correlating risk to volatility, and the reason is, kind of taking back from my personal experience. Like I graduated high school, went to college, did ROTC, and then commissioned into the Navy. And the Navy is not the important part, but for the government employees, right, you have this thing called a thrift savings plan, which is basically it's a 401k for the government. And within that 401k, you have different funds that you can invest in. And I just want to highlight two. One of the fund was called a C fund, or it's called a C fund, and basically, or it's the equivalent of a S&P 500. It's VOO or SPY. It's the same thing. And you also have the G fund, where you are investing in government bonds of all sorts, right? So I just kind of like initially thought about it, like reading the pamphlet of like TSP. I'm like, hey, like these are what the different funds are. Like these are the risk levels, blah, 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 blah. And I remember they put the C fund or the S&P 500 as very risky. And they put government bonds as low risk or zero, like almost close to zero risk. And in terms of the definition of risk with volatility, I do agree with that statement.
Yep.
But my definition of risk, like I would not call the S&P 500 risky, because giving a long enough time frame, we have seen the S&P 500 or just the US stock market. We have continuously hit all-time highs after the Great Depression, after World War II, after Vietnam, after assassination of presidents, after 9/11, after COVID. We have seen S&P 500 hit all-time highs after everything. So therefore, I don't necessarily think giving a long enough time frame that S&P 500 is necessarily risky. Would you agree with that statement from my definition of risk?
Yes, great. Yes, absolutely.
Whereas when you're looking at investments, right, you can't just go off the percentage increase of your investments, because that doesn't tell the whole story. Because imagine if you're in Zimbabwe. If you invest in the stock market, you're going to have like $1 million or million percentage returns. You're like, dude, you're the greatest investor of all time, like 1,000,000% a year on average. But then look at what the Zimbabwe dollar is doing, right? Like you are losing more to inflation than what you're getting. So when you look at stock returns, you have to consider the real nominal returns versus like this fake return that you might just see on your screen. And if stock market returns 10% on average, but inflation runs at 3% average, your real returns are only 7%. So that is part of the thing that I was thinking about. And when you invest in government bonds, like think about like during after COVID, right? Like inflation was running at like 8%, 9% on an annualized basis for a little bit. That's a crazy high inflation that we have like seen, very small amounts of in the US history. And when during those times, at least stocks were they were returning pretty good numbers, except for the downturn in like 2022 to 2023 that, tech kind of fell down. But regardless, if you invested in government bonds, knowing that you're going to get 3% return and inflation was running at, let's just say 5%,
Over
you
3%,
are
yeah.
locking in a 2% loss, guaranteed.
Mm-hmm.
So if someone came to me and was like, hey, here's this asset that over time, over 100 years, you're going to get an average of 7%, or you have this thing that's going to return you 0 or negative something percent. Like, which one are you going to take? Like, you would be so stupid to take the guaranteed loss. So that's how I thought about government bonds. I think there is a time and place, a strategy that you can utilize government bonds for. But in terms of a long-term investment, I just don't think it's the right play. So that's my definition of risk, and that's why I had an issue when they said S&P 500 is risky. Because if you go into a regular stock investor and you said, yeah, S&P 500 are risky, they'd be like, you don't know anything about it, nothing, right? It's just not a factual statement. So that's just why I don't agree with the volatility equals risk definition, but that's just my take on that.
Bro, I love that because I agree with it, and I feel like you just took the risk, how risk is viewed, and then like flipped it on its head, and that's some true rebel stuff right there. I like that. We like that here. Heck yeah. But it's so true. Like, and I think it's only like that because it's like comparative risk. They're comparing. I can't even say that. It's just volatility. Yeah, it's really just volatility. Yeah. I was gonna say they're comparing the risk of S&P to like government bonds, but yeah, it's just government bonds is safer, I guess, quote unquote. But nah, dude, that's great, honestly. Which, yeah, I don't so this is kind of a bigger, broader question. Do you think if MBT redefines risk or looks at it through a different lens, like that will completely alter the theory? You know what I mean? Do you think they need to like revisit? We need to revisit because I think it works like for that theory. Yeah, this is like a very, very vague question.
No,
I don't even have an answer for it.
For how MPT is designed and implemented, I think the definition of risk makes sense. But on a greater context of just risk alone, that definition I just disagree with. So I don't know. I don't necessarily see issues of MPT and how they incorporate the definition. No, I don't have any issues with that personally. I think it is. It is a greater way. I don't want to say good or bad because I think it's all relative, right? Because I guess one of the drawbacks to MPT is if you want to make your return or risk level at a certain manageable level, the drawback to that is you are gonna take time to grow to an amount that like actually makes a difference. Whereas, like something that we don't necessarily recommend because the success rate is so much lower. But if you want to become a millionaire in the next year, you're not going to get there by MPT starting from zero. It's almost impossible. You have to take crazy amount of risk, being okay with losing that amount of money to chase that higher yield. And that's it just kind of looking at, do you want to sacrifice time or do you want to set a time and maximize for that amount of time? And hopefully that amount of time, the longer, the better. But yeah, I guess that's one drawback, right? But one thing I do want to say though, with combating that drawback of time and the volatility piece is if we change the definition of risk in the MPT, you can take advantage of it because I guess not necessarily like change the definition, but like if we implement MPT in a way where you're okay with higher risk, and this risk is volatility because it's MPT, and if we're saying that S&P 500 is more volatile, sure, I can buy that. But the counter to the drawback is dollar cost averaging, because if you set up your MPT in a way that you're growing I don't know, 12% a year, whatever, right? Your assets are gonna have downturns and also like bear market, bull market type scenarios, right? You can have assets that go down while the entire portfolio is going up. But if you dollar cost average into those stocks or assets that are going through a downturn, if the average is 12%, when you buy at a downturn, you are essentially increasing your returns when it comes back to the average, right? Because stock market is, or
Yeah.
I guess I'll just say stock market because that's what I know for sure. I don't know about other asset classes as much, but stock market at least is like a rubber band, right? Like you pull, you pull, you pull, and you can't pull anymore, and it snaps. So it goes up, 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 up to an unsustainable level, and it goes down. It goes down, 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 down to a unrealistic level, and then optimism kicks in and goes back up, right?
Mm-hmm.
So I'm not saying I wouldn't mess. I mean, me personally, I don't like to mess on the high side. Like if it's gonna keep going up, like I don't know when it's gonna stop going up.
It's
So
gonna
I don't
stop.
want to necessarily sell.
Yeah.
I'm okay with holding. But when
Yeah.
it goes down, you know for a fact that the stock price is
It's gonna
lower
come back up.
than yesterday or whatever the average, right? So by purchasing though, when you buy it during that downturn, when the stock goes back to the average level, you're capturing that delta right there. Let's say you had a
Mm-hmm.
4% downturn from the average. When you buy, you're locking in that 4% to get back to the average, and from that it's 12%.
Yeah.
That now you're locking in 16%. Right. So I think that's the best way to combat the drawback of, I guess, volatility or risk in the MPT. Just DCA. That's my overarching point.
Very. I think it was well said. I have nothing. I mean, nothing I disagree with. Nothing I disagree with, or nothing even to add. I feel like, which is rare.
No.
But heck yeah. Do you have any more overarching thoughts on MPT?
Yeah. How is your portfolio looking like? I'm just trying to see. Like, do you
Yeah,
calculate
I
like
have.
asset allocation, like percentages, and what's your
No,
ideal?
I don't. But this is one thing that MPT has got me interested in, and that maybe I can, because
Mhm.
that I don't calculate it to that level. And this is also very ironic because I don't mess with bonds at all, and I don't think you do, but I don't know if you do, like in your current portfolio. But given the you and I were just talking about trying something different that neither one of us invested in, like, what was that, a couple of days ago, and then now here we are talking about like MPT and diversifying in this way. So I think that's pretty like ironic. But no, dude, I don't mess with like the weights of the asset class and
Mhm.
anything. But it might be something I look into.
Yeah. Well, at least I want to share
Yeah.
mine, and then this is more for. I want to let you know because we talk very frequently, but hopefully
Mhm.
if I'm not saying anyone to follow my asset allocation, but like this is
Right. Not
my
financial advice.
not at all. Like I'm just a random dude that does not barely knows anything. So, but then I like thinking about this stuff. It makes me feel better.
Yeah.
So I guess it's to
Yeah.
inflate the ego, I guess,
It's
right? But
fascinating.
basically, like how I'm thinking about it, and I really do want to follow this, and I'm kind of working on it right now. And then out of the 100%, the allocation that you can
Mhm.
give, this is my current goal. It's not there yet. This is my current
Okay.
goal of where I want to start allocating
Okay.
equal but different weights, right?
Mhm.
And I want to have 35% of my net worth in stocks. And stocks can be, your Roth IRA, it could be your individual
Yeah.
tax account, it could be
Retirement
your
account.
retirement
Yeah.
account, things like that. So I want 35%. I have I have real estate, and I want that to be 35%. And I like real estate just because it's a leveraged asset. It's generally accepted to buy real estate with loans, and then banks view that as pretty safe. So you are investing in something that's low risk, but then to amplify that return of low risk, low return, you are leveraging it with loans. And the real estate, it's interesting, right? It's such an interesting asset class because it is one of the only asset class. I mean, real estate is a big term, but big umbrella. But no other investment that I am aware of you can buy on a loan and then try to optimize it in a way where someone else pays off your loan.
Yeah, right.
Like it just like how do you do that? Like you can't do that with any other thing because obviously, I mean, you're providing a service of providing a livable condition to someone else, but like you can borrow money into stocks. I mean, it's very hard to. I mean, you can, but you have to pay back those things. Even if you go up or down, like you still have to pay back that loan. Whereas real estate, like I guess, I mean, if you do it poorly, you would have to pay back that loan. But like it's not really you that's paying it off. That's my point.
Right.
So you have I have 35% stocks, 35% real estate. So that's 70. And the last three is those 10%, 10%, 10%. And the first of the 10% is Bitcoin. And I say Bitcoin as in Bitcoin, not crypto.
And not crypto, like specific Bitcoin. You said that specifically? Okay.
I have Bitcoin by itself as 10% of my net worth. I believe in Bitcoin. But even
clearly,
the level of my conviction of Bitcoin reflected on my asset allocation should be much higher. It should be at least
based
like
on
50%.
how you believe in Bitcoin. Yeah.
But even though statistically, Bitcoin, you can calculate the returns for the past, 12, 13 years. But I don't think I'm dumb enough to understand that other asset classes have been around for much longer. That gives me a bigger conviction.
Yeah. So you're just kind of hedging. Yeah.
Right. And I'm okay with 10% Bitcoin just because if Bitcoin keeps going up at the rate that it does, I don't think so, because as a asset class gets bigger and bigger, it's like a law of large numbers. You're going to have less and less return. But the less returns that we're talking about is like double digit, like 20, 30%. Because I think if you calculate everything, Bitcoin has averaged, I think it's somewhere between 50% and 80% annualized every single year. So which is like that statistic alone, you should be like 100% Bitcoin, right?
Yeah, right. Yeah.
But looking at the holistic picture, like it's not as proven yet as the stock market, right?
Okay.
And then, it's, props to people that believe that, it's gonna be the digital gold, right?
They going to the moon.
Yeah. So that's why I keep it at 10%. And even if Bitcoin went to zero, I don't think at the point we're at today with retirement funds buying, countries buying, municipalities buying, like I just don't think that's going to go to zero. But if it goes to zero, it's just 10% of my portfolio. I will live. My quality of life is not going to change. But
well said,
if it returns that, let's say 40%, and then I was expecting 10 for the other asset classes, even if I have 10% allocated, if that's growing at 40%, that's kind of that kind of makes up for the less allocation, and it's made up by the growth, right?
Right.
And the next 10% is crypto. I have crypto. This is the is the speculative portion. Out of the entire 100%, I have 10% allocated to the very speculative, I guess, asset. And I would call crypto more speculative than Bitcoin in itself. So, within that, I have like the big name. I don't have any meme coins. I could see, I see the role that meme coins play. It's more of the high risk, high reward thing. I'm just not too in tune in it. So I don't have anything in my portfolio.
Yeah, I feel like that gets into the gambling world to me.
Yeah, it is. I do think so. But so I do have the big name cryptos in my portfolio. But again, that's probably the most risky portion of my portfolio that I'm okay if it loses everything. But
Okay.
then again, it's 10%. So if it grows a lot, like I could benefit a lot from it. And then the
Yes.
last 10% is cash. I do want to hold cash. I'm starting to realize, like, if I had 10% cash laying around at these great market downturns, like, that 10% is gonna grow like crazy if I invest
Mm-hmm.
it at a good timing, right?
Correct. Yeah.
And I'm not
So you're
saying
saying
I'm gonna
you've no, go ahead.
like, I'm not saying, if I'm not saying like I'm gonna invest that 10% cash at one time, but I don't have a method yet, but I need to come up with a method that I can follow where, if stock market goes down by 5%, maybe put in
Yeah.
2% of the cash. If it goes down by 10%, put in half of my cash. If it goes down by 20%, put all my cash in there. And if
Yeah.
it's going down by 30% or more, I need to borrow as much money as I possibly could to invest in the stock market, because that's just not sustainable to go down by
Yeah.
30% and stay there, or at least history has shown that it's not sustainable. So that's
Right.
my allocation and like the reasoning behind my allocation.
You have so many numbers tied to everything, which I applaud you for. That's I think next level. And then since we were quoting Warren Buffett earlier, and what you just said about if there's an economic downturn or whatever, I feel like that aligns with one of it. And this is where I thought you were going earlier, because one of his big quotes is I'm gonna butcher it, but something along the lines of like, when everybody else is scared, go big. When everybody
Yeah.
else is going big, stay reserved. And I feel like that kind of aligns, that last thing you said, with that, Warren Buffett philosophy. But I want to ask, where did you, or is this just over time you developed those numbers? Where did you get that breakdown, that 35, 35, 10, 10, 10, I think it was? Or did you just, like, is that borrowed from somebody's philosophy, or
No.
you just kind of developed it?
Yeah, I think it just came naturally over time because, like, for the longest
Okay.
time, like, I was pretty much 100% stocks. And then I really wanted to invest in real estate. And then my real
I
estate
was going to
just
say,
got
you've been real estate, but you're talking about before real estate.
yeah, before real estate. And then
Yeah.
probably the peak, like I probably went like 70 or 80% of my net worth in real estate. Uh, so I didn't, I guess I was okay with that, but I didn't like it, I guess.
Ideal. Yeah.
Yeah, it wasn't
Yeah.
ideal just because as an investment, stocks is just much easier. You just press a couple buttons and
Mm-hmm.
then you
Yeah.
own asset, right? Like real estate, it takes work. And I think obviously like I'm getting in, I learned enough to the point where it doesn't make sense for me to go back anymore. But then like realistically looking at it, if I were to start over, like I probably wouldn't go into real estate at all just because that
Mm.
you need to know a lot to maximize for that return. Because
Mm-hmm.
if you're just a regular Joe, if you're willing to learn, like it'll be good.
Yeah.
But if you're not willing to learn, the like stocks will just be
That'll
easier
really
and they'll
say.
probably give you
Yeah.
better returns for less risk.
Yeah, your
And then,
portfolio, I mean, as it should, sounds very personalized, but like also like optimized. Like, you can see the optimization in it and like the thought. Yeah.
hopefully it's optimized. We'll see in about
Yeah, yeah. You're
50
trying to
years.
yeah, right.
But yeah,
I mean, and that'll change too as your life changes. Like, you will tweak, and
yeah. And honestly,
as the
like this is my
market
current allocation, but then as time goes, I
right.
do see myself putting stocks heavily over real estate just because like at that point I don't necessarily care about the returns. I rather trade that I rather trade lower percentage growth so I can optimize for just living a simple, comfortable life. And that's where stocks
Yeah.
come in very handy. And then, yeah, 10% cash. I was always so bad about holding cash. I'm like, dude, just holding cash in my bank account was just wasted money. I always used to think about it. So whatever, I would just have my little bit of money on the side and I'll just invest everything else. I guess which it's not the worst strategy, but as these downturns come, I'm like, only if I had this much money, like that would have been perfect. And
Mm-hmm.
this much money is something that I would had if I actually kept a cash pile. And I'm not me as a person, even 10% cash is very hard for me to hold Just because I'm just such a
Just because yeah.
me personally, I think that stock market is gonna just go up and up forever. It's just my optimistic thinking, but in reality,
Right.
I know that that's not realistic. So even holding 10% is hard, but then I know it's the smarter thing to do. And then I'm just a believer in Bitcoin, so that's where the 10% comes from. And I don't necessarily view that as my speculation investment. I mean, we'll see, right? I think the trends are
Right.
showing that it's
Yeah, I guess.
not speculation, but and then I have 10% of my portfolio, which is crypto. That's my
Which is your
speculative
speculation.
assets. Where like
Yeah.
truly, it's just more like fun and play. I don't
Yeah.
understand every single detail of all this stuff, but then I could see a world where we go more and more digital, and that's pretty much my investment thesis behind it.
We'll say. I can tell just even hearing you talk. I mean, knowing you, but like even in this episode, like you're becoming more bullish on cash, which yeah, I don't know. I just think it's funny. It's more funny for me because like knowing you, I know it's probably like super hard for you. That's good, man. And it also is motivational for me to like really dig in and come up with, I mean, where I sit now, but also the goals like you just laid out where I want to
Mhm.
be. And I also want to contrast that quickly. You know, we're talking about the weather portfolio early, and I just did a quick like what's the I don't want to say recommended breakdown, but it just says a common allocation for the weather portfolio, which we talked about earlier in this podcast, right? And it says 30% stocks, 40% long-term bonds, 15% intermediate term bonds. And it kind of gives a breakdown. Actually, so I'll read the little breakdown again. So 30% stocks for performance during growth periods, 40% long-term bonds to perform well during deflationary and recessionary periods. Because remember, this weather portfolio should cover all periods. 15% intermediate term bonds to provide stability. 7.5% gold, a traditional hedge against inflation and safe haven assets, I guess. And then lastly, the 7.5% commodities to protect against inflationary spikes. I think commodities is just like energy or metals, like
I,
stuff like that.
I guess gold would be technically under commodities, but it's big enough asset
Commodity,
class
right?
that they're
Yeah.
just putting it on a separate bucket. That's fine.
Yes.
But yeah, commodities like oil, it's just like hard. It's like hard assets.
Right. Kind of like you and your Bitcoin, like you have 20% where you want to get crypto, but 10% of that crypto you want Bitcoin.
Mhm.
Yeah. So I just throwing it out there. No, nothing to dive into, just to kind of contrast what you just laid out. Just again, for people to think about. And again, I think this is all going on like personal goals and beliefs. Like you said, that was your, I guess, like investment thesis, or for you. So I think it's like personal, and then also like economically where we at, I think would also influence that portfolio. But yeah, just something to throw out there. Dope. Damn, that was a good. I think that was a good little segment, dude. I have no more. I think we're in a good spot for MPT. What do you think?
Yeah, it's. I mean, I yapped and yapped and yapped around, so I think I had enough
No,
to
dude,
say.
that's why we're here. That was very, very necessary, I would argue. Dope. All right. Well, that's our take on MPT, modern portfolio theory. So I don't jack it up. And again, I think I won't even say budding concept has been around for a while, but growing, and again, just some things to chew on, especially in the investment space. Thank you for joining as always. Catch us next week with a fresh topic.